we're back with TikTok financial advice, and let's start off with a positive example after the horrible examples of the last episode. Let's go.
What's the best financial advice you would tell the younger generation of kids coming out of school today?
First of all, everything that glitters isn't gold. Everyone that you see driving a Lamborghini and wearing flashy clothes, they aren't actually rich. The thing about social media and the world these days is that everyone is selling a lifestyle that a lot of people aren't living, and then you go broke trying to keep up with that lifestyle. Don't keep up with the Joneses, even if you are making money. I know more millionaires who have sat back, lived below their means, and built their funds over time than I know millionaires who made $1 million in 1 year and then started buying Lamborghinis and luxury clothes. If you want to make money, don't try to impress other people. These are people that don't like you, you don't know them, they don't know you, so why are you trying to impress them? Instead, just be content with how you're living, and a great book for that is The Millionaire Next Door. It talks about how 80% of millionaires don't even live in mansions. They live in regular homes, and they were able to build money over time. So yes, I will encourage you to make a lot of money in a short amount of time, but that doesn't mean you need to go and spend money and live a lifestyle that's way above your means, because that is only going to lead to you blowing all of your money. This is 100 years. Poor people think in weeks and months. Rich people think in years, in decades. That's how you get rich, by thinking long term. Stop thinking like that get rich quick stuff is going to get you broke real quick.
That's really interesting. I agreed with most of what he was saying. So that's actually solid financial advice. I am surprised to find that on TikTok. Most of the things that he pointed out are absolutely fair. Number one, keeping up with the Joneses is a real thing. If you are moving into a more wealthy neighborhood, if you are climbing up the social ladder in your life, you will always find someone who does have more. It is very unlikely that you are going to be the biggest shark in the tank. And if you are, then you can trust me, there are places where you will find people with even more wealth. So keeping up with what everybody around you seemingly has is a fool's errand. Then he talked about social media and the illusion of grandeur that many of the lifestyles that are being sold are trying to portray. And that brings me to the question, if people, or how people would know, potentially they wouldn't, but to kind of showcase how a millionaire or a multi-millionaire is living, you're typically a fool if you're following the media-induced image of that, because in order to live in a mansion, have a chef or a butler, and drive a vast variety of Lamborghinis, you are not only needing to be a multimillionaire, you need to fall into the ultra high net worth category, which is 30 mil up, and you will need to have very steady income. Otherwise, you just couldn't afford the burn rate that comes with what you are just witnessing. That's the reason why so many NFL players are going broke. That's the reason why so many people that win the lottery are becoming broke within actually the first 3 years after winning the lottery. Most of them are picking kind of the lump sum payment, which is even way less than the regular annuity that they could get. So there are many things with what he has said that is very true, and one of it is the lifestyle that you imagine you could buy for $1 million. Depending on where you're living, $1 million, funnily enough or sadly enough, isn't even providing more than a moderate medium lifestyle, and you will need to work on top of that. So you can't just retire on that if you're, for instance, living on the west coast of the United States. And then finally, he talks about a couple of other things like those who matter don't mind, and those who mind don't matter, which is a great advice, and also the longevity of thoughts that you should have in your financial planning. So I actually appreciate that young gentleman's comment. I think the words that he had spoken were quite wise, and it's good financial advice. Moving on to the next one. All right, from sound financial advice to stupid one, let's go.
So the fastest way to make $10,000 online is not going to be trading. It's not going to be TikTok shop affiliate. It's not going to be agency, copywriting. All these business models will not get you to 10K a month quickly. I will always say this, it's find a product that solves a problem, build a Shopify store around it, and launch some Facebook ads. If you really want to get specific with it, find a product that's doing well on TikTok shop, rip all the TikTok shop content, and launch that as your Facebook ad. That's the fastest way you can get to 10K a month. Now the beautiful thing about that is if you can get a dropshipping store, a branded dropshipping store to 10K a month profit, obviously, it's really easy from that point to take it to 100K a month profit. It's a matter of just spending more on your ads, just a couple buttons you have to press. That's why I love the business model.
So that's almost a carbon copy of the stupidity that I watched in the last video. There are so many things that are not correct with that advice. Whilst in theory, what he is saying can work, it is unlikely, therefore highly improbable, that you are ever going to be successful for that. For starters, no product that solves an issue has a low barrier of entrance. If that is the case, then everybody can copy it, and therefore you will have an oversaturated market simply by the law of demand and supply. That then leads, typically, with what he is saying, to higher prices in advertisement. What he's conveniently leaving out in his expression is that the Facebook marketing campaigns typically require you to really specifically target your audience, certain age bracket, certain demographics, certain educational background, certain interests, and so on. You can specify all of that, but you need to find niches or demographics where your product is actually working out well. So if you know that, and if you know how Facebook marketing campaigns work, you also know that there is no such thing as a limitless demand. That is simply not true. At some point, you're running out of people in said age group, and to simply use TikTok content, which typically caters to a demographic of 10 to 25, so Gen Zs, and then applying it to a Facebook platform, which has a much larger array of ages and is rather weak-ish on that lower end spectrum of age, so 10 to 25 years, is not a recipe that is going to work particularly well. And I'm even leaving out all of the copyright infringements and IP issues and litigation that you can run into. You're simply copying something. But here's the thing. If you are always just following dropshipping and you think that you can just 10x the marketing budget, that's going to magically lead to more revenue, and that is just a fool's errand. He isn't even talking about the whole fulfillment. He assumes that someone else is going to do that for you without a problem. And mind you, if you are paying someone else to do that and you're paying someone else to competently do that, that also lowers your margin. So his thought that you can reach 10K profit a month with that and then easily scale it up to 100K profit per month is just blatantly incorrect. That is not how it works, because the market dynamics underneath it simply do not support that, and specifically not on a long term. So his get rich quick is just incorrect. It is bad financial advice. All right, one on the road. Let's see what the senior guy has to say about getting rich.
You'll never get rich in your 20s unless you do these 5 things as soon as you get paid. Firstly, use 50% to pay for your needs. This is your food, rent and electricity.
I like that comment so far. He should elaborate a little bit more on it. In order to pay all of those 3 necessities with only 50% of your income, you need to find a living situation where that is possible. In many of the urban areas in particular, you will have a high probability that the rent alone will be almost 50% of your income, unless you're making a significant income in your 20s already. So you should have said move together with a friend, colleague, or significant other, share the rent between the many of you, and then find a way of staying below 50% so that the rest is savable assets. I agree with what he's saying. Your saving rate early in your career should be around 50%.
Secondly, save 20% in a high interest savings account. This is your emergency fund.
So far also okay. He should say that the emergency fund needs to last you 3 to 6 months. So whatever expenses you had should be covered within that emergency fund. Once you are over that period, however, you can then invest into higher yielding assets, because emergency funds typically are just checking accounts or high saving accounts, and they are not yielding enough interest over time. But so far it's okay.
Thirdly, use 30% to pay off any high interest debt. This is your credit cards and car finance.
Well, I don't know if I combine tip number 3 with tip number 2, it doesn't make a lot of sense. If you do have debt, specifically high interest debt, then I would always advise you to pay that off first, before you're even starting with your emergency fund, because you're effectively losing quite a bit of money on the higher interest side. And if you do have, for instance, a credit card and I don't know, you have X amount on it, and you're then putting, instead of paying down the credit card, you're putting it into your saving account, then you're still accruing interest over time, and that will eat up portion of your income. So I don't agree with that. The order should be pay off the high interest debt first, and then get to a financial cushion of 6-month emergency funds.
Fourth, once you've paid off your high interest debt, use 25% to invest tax efficiently. This is to grow your wealth.
Yeah, I can see that, but he should have said once you have paid off all of your debt, and not once you have paid off just the high interest debt, because chances are that when you are having debt, the interest rate on most of that will exceed 6-ish%. Even student loan and car notes would easily exceed that portion. And in order to gain 6-7% in a secured fashion on the market, you would need to invest in equity, which is a volatile asset, so it will not always yield that amount of income. So instead of basically investing and generating wealth while still being in debt, I'm a big proponent of getting rid of your debt before you're thinking about any other investment strategy, because the reality is that you are typically not going to out earn most of your debt. And then let's listen to this last tip.
Fifth, put 5% to some risky plays like starting your own business. This is your chance to make some fast money.
I don't like that tip. While I agree with the notion of it, which is the earlier in your life you can still put a portion of your investment portfolio into higher riskier assets or high risk assets that have a higher return, because you have more time to make up for potential losses throughout your career. That part is correct. What is blatantly incorrect is that he suggests to start your own business, because that then becomes a side hustle, and then you haven't really created any investment. You've only created more work for you that detracts you from your main source of income. And before you haven't secured like a main source of income that very, very, very comfortably will fund your lifestyle, you shouldn't really think about getting that second or third source of income. So I don't necessarily agree with that portion of it. Anyways, today we've seen a bit of hit and miss. We saw some good financial advice, some horrible financial advice, and then something in between with that older gentleman here. Let me know what you think, and see you in the next episode. Bye-bye.